Hello, this is Mike Swanson of WallStreetWindow.com. I got a very special guest with me today. I'm speaking with Ike Iossif, who runs the website MarketViews.tv. How you doing today, Ike?
I'm doing well, Mike. Thank you. Nice talking to you again.
Yeah, you did a very fascinating analysis, and going to have the charts along with the audio we do so people can see exactly what we're talking about. But you looked at the advanced decline line and compared it with the percentage of stocks above the 200-day moving average indicator for the New York Stock Exchange. And that's an indicator I like to use quite a lot. These two things are diverging from one another, and it's a kind of a puzzling situation. These are both indicators used to measure the internal strength of the stock market. I'm very glad you did this analysis to explain what's going on and help us understand how these indicators actually work better.
Mike, as you know, I talk to lots of technicians like yourself, and the AD line is a very respected indicator. Throughout the years, most technicians look at it. Some put more weight than others, but all technicians put at least some weight on it. And one of the interesting things that we have observed since the beginning of the year is that the AD line is doing relatively well. In fact, it's making new highs. But there are two other components, two other indicators that usually confirm it that have not. One of them is price itself. The first chart is the NYSE, and we can see that the NYSE is just 100 points above its 200-day moving average. Yet the AD line is making new highs. That's very unusual to see the price hovering around the 200-day moving average, and yet the AD line is making new highs. The next issue is the percentage of stocks above their 200-day moving average. That is also a very key indicator. And we can see that back in January, as the market was topping out, 75% of the stocks were above the 200-day moving average, which is normal. Now, while the AD line is making new highs, the number of stocks above their 200-day moving average is about 58%. So when you look at the AD line and you compare it to the price and the number of stocks above the 200-day moving average, something is off. Because that was a topic of conversation with many technicians that I know, I try to explain it, find what was behind it. So the first step that I did was to create a very simplified model that will recreate the conditions under which something like this can happen, and then see if these conditions were applicable to the real market, to the real data. And that is our third chart. Now, the third chart pretty much demonstrates this. Whether a stock goes up 10% or loses 10%, from the AD line, we only subtract one unit. For example, let's say IBM. It went down 10%, hypothetically speaking, today, all right? Well, from the AD line, you're going to subtract one unit, all right? Tomorrow, let's say IBM is up 1%. To the AD line, you're going to add one unit. So from yesterday, between today and tomorrow, actually the AD line is going to show no change. -1 today, last one tomorrow, no change. Yet IBM will be down 9% from today until tomorrow. So that is an important concept to understand, that regardless of the magnitude of the move in individual stocks, from the AD line, we only add or subtract one unit of measurement. So one unit of measurement could represent a half percentage point move in price or 20% move in price. So now let's take a look at this simple model that I put together. Now let's say we have a hypothetical index and we call it XYZ. This XYZ index is made up of only 10 stocks. And on day one, the index is at 100. The AD line for the index, which is the red line below it, is also at 100. Now for a 5-day period, something catastrophic and terribly bad happens. So the index loses 20% of its value. From 100 goes down to 80. So we're down 20%. During this 5-day period, all 10 stocks are down for 5 consecutive days. So if all 10 stocks in the index are down for 5 consecutive days, at the end of the 5th day, you're going to be down 50 points. So on day 5, the index is down to 80, which is 20%. The AD line is down to 50. From 100, we have subtracted 10 points every day. So 10 times 5 is 50. So we went from 100 to 50. So under extreme conditions here, we see the index falling 20%. At the same time, the AD line was down 50%. Okay? Now with the next 20-day period, the index closes way back again. It's usual to have in an uptrend the market to gain on average about 0.75%, 0.75. So I have used that figure. So over a 20-day period, like from day 5 until day 25, if the index is gaining 0.75%, 0.75, then after 20 days, it would have gained 15%. So from 80, it would have gone to 92.
Okay.
Okay, it would still be 8% below its high, okay, but it would be at 92. Now, during that period, some days the market, would be up, sometimes it would be down, but on average, if let's say 7 stocks are up and 3 are down, then on average we would have a net gain of 4 units of measurements. Okay, 4 times 20, that's 80. If you add the 80 to 50, you have to 130. So what does that mean? Let's start from the beginning again. On day 1, the index is at 100. In 5 days, it loses 20%. At the same time, all 10 stocks that make up the index are down every day. So in 5 days, the AD line loses 50 units. So on day number 5, the index is down 20%, the AD line is down 50%, yet over the next 20 days, the AD line, if it only gains 4 units a day, over the next 20 days, it's up 80 points. So from 50, it will be up to 130. So a 15% advance in price, if it takes place over a 20-day period where the general trend is up, some days you're down, some days you're up, but the overall trend is up, then you have a 260% advance in the AD line. That would put the AD line 30% higher than its level on day 1, and the index 8% lower than its level on day 1. Okay? What does this all mean? It means simply this, that when a steep decline takes place over a short period of time, and the recovery takes place over a period of time that is usually 3-4 times longer than the decline, the AD line will outpace price. Now, I share all that with you, and I shared also with my good friend Jim Wells, and people who listen to me, they know Mr. Wells from smartwells.com. He's a frequent guest. And Jim said, well, let me check this out and see how it applies to the actual data. So, Mr. Wells, look at the AD line and price and how they behave from January until actually mid-June. And then what happened, he noticed that from the high in January until the low of February, that was like 12-day decline. On average, declines in the advanced line exceeded advances by 825 points. At the same time, the S&P lost on average 21.5 points, okay? Then from the February low until mid-June when Jim looked into it, the AD line had gained on average 191 units, while the S&P had increased 2.3 points per day. We see the discrepancy between the advance in the AD line and price. The actual data confirms that oversimplified model we discussed earlier. We had a large decline in a very short period of time. Subsequently, the advance that has taken place has not had very large magnitude, but because the duration of the advance is actually 5 times, let's say at this point, almost 8 times longer than the decline, that has resulted in the AD line making new all-time highs. The question is this bearish? Is it bullish? At this point, when you look at the overall market, in my view, it's neutral. And it's neutral because as long as price is behaving positively, then that's what it is. But it is bearish for the sector of the market that is actually leading the market. And that is the 15-20 stocks that are actually impacting price.
Why would it be bearish for them?
Because what happens is that when you have an outsized advance in an index, and let's say that advance is based on 10 stocks or 15 stocks, the other 90, 85 haven't really done much. When you get the correction, you don't get in the stocks that haven't really moved much. You get in the stocks that have moved the most.
Oh, okay. So they're the ones that would be most in danger at some point.
Exactly. I mean, my interpretation of this is that shows elevated risk in this, very crowded trade of trading Netflix, Facebook, Microsoft, Alibaba, Tencent, Baidu. You have 10 stocks that pretty much are the leaders here, okay? In any impending corrections, this is where you'll get the most pullback. If a stock moved sharply lower in February, and from February until now really hasn't done much, you're not going to get much of a pullback there. It's the stocks that have gone parabolic that will get the most, the highest percent of decline. So short term, this tells me that this overcrowded trade in the 10, 15, 20 stocks has risk that is above average. As far as the overall market is concerned, for now, I think it's neutral until price begins to confirm what the number of stocks above the 200 is saying, and also the price itself moves below critical moving averages. So look at the AD line. It is an important indicator. okay? But by itself, it's not the holy grail. And there are other things that people need to keep in mind. And to sum it all up, if you're in a crowded trade, means you should be dancing close to the door.
Well, for me, I can just tell you, I never really use. I know you use it more, and you also use the AD volume line, and you've got your own indicators too. But because I got into the market in the late '90s, and the AD line didn't confirm the action for several years. It didn't work as an indicator. I just never even used it, even though a lot of people talk about it all the time. And I just seen so many people talk about it the past couple months that I get emails. Why, what do you have to say about it? And I really don't have much to say. And I feel like it's very. You've helped me to learn why it doesn't work when it doesn't work.
Look, just like everything else, okay, looking at the surface, it doesn't tell you much. You have to have deeper understanding of what this thing that you're looking at represents. Most of the people who are commenting don't have a clue about technical analysis and how one particular number is arrived at. And what I'm saying is the AD line is an important indicator, but not by itself. In conjunction with price and the number of stocks above the 200 moving average, and I may add also new highs versus new lows. All these go together. Isolating one, and trying to come to a conclusion is inaccurate at most. Mm-hmm. You need to look at the whole picture.
Right. Well, it's going to be interesting to see what happens in the next couple of weeks because we've got earnings for most of these, so-called FANG stocks coming out next week. So I'd be curious to see what's going to happen with the market after that. So we'll see.
Yeah, definitely so.
Well, thanks for talking to me, and anyone who wants to get more of your information, I'd recommend go to marketviews.tv, and we'll see where things are going next time we talk.
Mike, thank you. Great talking to you as always.
Thank you.